Between February and November 2024, the world's wealthiest individuals, the architects who command trillions, initiated a maneuver so profound, so terrifyingly coordinated that it should have shattered the foundation of every financial market. They sold over $50 billion in stock, not quietly, not gradually, but in a massive synchronized liquidation that set off deafening alarms across the inner sanctums of Wall Street. Look at the data, look at the names. Jeff Bezos executed a colossal strategic sale of $13 billion in Amazon. Mark Zuckerberg dumped over $9 billion in Meta across constant, calculated transactions. And the most chilling signal of them all, Jamie Dimon, the legendary CEO of JPMorgan Chase, the ultimate financial survivor, sold stock for the first and only time in his entire 18-year tenure as CEO. Larry Ellison unloaded $3 billion in Oracle. The Walton family, the dynasty behind Walmart, dumped $2.3 billion. Even the high priests of the current bubble, Nvidia insiders riding the AI boom to all-time unsustainable highs, sold over $1.2 billion, while simultaneously assuring the public, the best is yet to come. This isn't portfolio rebalancing. This isn't passive estate planning. This isn't simple tax optimization. This is an exodus. This is the smart money, the omniscient money, running for the financial exits. And they are executing this exit at the exact same moment, using the exact, chillingly precise playbook they utilized in 2007, just before the global financial crisis annihilated $16 trillion in wealth and sent the market crashing 57%. Here is the central truth that most retail investors fail to grasp, the lesson that will determine your survival. These are not ordinary investors prone to emotional decisions. Jeff Bezos built Amazon from a garage into a $2 trillion empire over 30 years. He lived through the dot-com massacre, the 2008 collapse, and the COVID volatility, and yet he never sold at this scale, this speed, this velocity, until now. Jamie Dimon has been the undisputed leader of America's largest bank since 2005. He survived the 2008 crisis. He has seen every market shock, and in 19 years, he never sold a single share. Until this year, these men do not panic. They operate purely on data, forensic analysis, and proprietary, perfect information that is entirely inaccessible to the public. And right now, that proprietary data is screaming a unified, non-negotiable command. Liquidate. The cascades are coming. Let me show you exactly who's selling and exactly how much, the 5 absolute historical patterns that prove this level of insider selling predicts every major crash with terrifying 100% accuracy. What 7 critical metrics these billionaires are seeing that the public is blind to? Why 2025 and 2026 represents the most fragile, dangerous setup since the 1929 Great Crash? Who will be financially destroyed? Who will engineer generational wealth? And the immediate, critical action plan you must implement right now to position yourself before the final cascade begins. Because this is not mere prediction. This is the predictable, cold, mathematical terror of pattern recognition. And that pattern is giving us a highly limited, non-negotiable deadline of 6 to 18 months before everything breaks. Before I detail the specific, staggering sales figures, you need to fundamentally understand what insider selling actually means and why it matters more than any analyst rating. Insiders are corporate executives, board members, and major shareholders who have access to non-public material information about their company's true financial health. When they buy or sell stock, they must report it to the SEC within 2 business days. These reports are public. Anyone can see them, but most people, tragically, don't look. Why does this information matter more than anything else? Because insiders know more than you ever can. Jeff Bezos doesn't just see Amazon's quarterly earnings report like you do. He sees daily sales data, margin trends, competitive threats, internal forecasts, and the problems that are developing months before they hit public earnings. Jamie Dimon doesn't just read about the economy. He sees JPMorgan's loan default rates in real time across every sector: commercial, real estate delinquencies, credit card charge-offs, corporate, bankruptcies. This is proprietary non-public information that won't appear in the news or government statistics for months. And when these insiders see the systemic trouble gathering, they sell aggressively. The quantitative proof is irrefutable. The data on insider selling is tracked by multiple firms. But the most comprehensive is the Washington Service, which has monitored insider transactions since 1975. They calculate the insider sell-to-buy ratio. This is the metric that measures how many dollars of stock insiders are selling versus the dollars they are actively buying. A healthy normal ratio is around 2-to-1 to 3-to-1. This is normal. Executives get paid in stock, they diversify some, they have taxes. A 2-to-1 or 3-to-1 ratio is business as usual. But when the ratio spikes above 5-to-1, it's an immediate, flashing warning. When it hits 8-to-1 or 10-to-1, it's the screaming alarm of financial doom. And in 2024, the aggregate ratio hit 9-to-1 for the full year. In certain critical months, it spiked to an unbearable 12-1. Insiders are selling $9 of stock for every $1 they rebuying. This is the most extreme imbalance since 2007. And we know precisely the devastation that followed in 2008. Now, let me show you the specific names and numbers because the scale, the coordination, and the velocity are unprecedented. Jeff Bezos, Amazon. In February 2024, Bezos announced plans to sell 50 million Amazon shares. He executed these sales throughout February and March, totaling approximately $8.5 billion. Then, in July 2024, Bezos filed another selling plan for 25 million shares, executing throughout the summer and fall for approximately $4.5 billion. Combined 2024 sales, over $13 billion. Let me put this in context. Bezos founded Amazon in 1994. For 30 years, he has been the largest individual shareholder. He sold stock before, yes, but never at this scale and never this fast. His previous largest sale was $10 billion over the entire year of 2020, during the COVID crash recovery when stocks were cheaper. The 2024 sales are different, concentrated, massive, and executed at all-time highs. And his hollow public explanation? Moving from Washington to Florida to save on state income taxes. Bezos has been a multi-billionaire since 1999. He could have moved to Florida any time in the last 25 years. He chose 2024, precisely when Amazon is at a $2 trillion valuation and the market is at record levels. This is not tax planning. This is high-stakes, calculated market timing. Mark Zuckerberg, Meta. Throughout 2024, Zuckerberg executed multiple, relentless stock sales under pre-arranged trading plans. By November 2024, Zuckerberg had liquidated over $9 billion in Meta stock. This sale is notable because Meta's stock had more than tripled from its 2022 lows of $90 to over $500 by late 2024. The company's market cap surged past $1.3 trillion on AI hype and efficiency improvements. And at the absolute peak, Zuckerberg is selling billions. The official explanation: funding the Chan Zuckerberg Initiative, his philanthropy. That's possible, but Zuckerberg controls Meta through supervoting Class B shares. He has 61% voting control with only 13% economic ownership. He could hold his stock forever, maintain control, and fund philanthropy through borrowing against his shares at minimal 3% or 4% interest rates. Instead, he is selling at the fastest pace of his career, converting Meta shares to cash precisely when the stock hits records. That is not charity. That is the ultimate exit timing. Jamie Dimon, JPMorgan Chase. This is the most significant, the most chilling signal of all, the financial fire alarm. Dimon became CEO in 2005. For 18 years, through the 2008 financial crisis, the European debt crisis, COVID, every market crash and recovery, Dimon held every single share of JPMorgan stock he was granted as compensation. He preached long-term ownership. He explicitly told investors that CEO stock sales signal a lack of confidence. He structured his own compensation to be 80% in stock, specifically to align with shareholders. He was the ultimate believer. In 2024, that unwavering commitment broke. In February, JPMorgan disclosed that Dimon would sell 1 million shares for approximately $160 million. The official reason: estate planning and diversification for his family. Dimon is 68 years old, yes. But he could have done estate planning in 2010, 2015, or 2020, anytime. He chose 2024, and here is what makes this terrifying. Jamie Dimon has more information about the real economy than almost anyone alive. JPMorgan is the largest bank in America with $3.9 trillion in assets. Dimon sees everything: loan defaults across every sector, the absolute collapse of commercial real estate delinquencies, the true consumer credit quality, the corporate bankruptcies, the small business failures. He has real-time proprietary data on the entire economy that won't appear in government statistics for months, and for the first time in 18 years, he is selling. That is not estate planning. That is the final decisive action of a man who sees the financial cliff edge. Larry Ellison, Oracle. Ellison, co-founder and chairman, sold approximately $3 billion in Oracle stock during 2024. Oracle surged on AI infrastructure demand. The stock went from $80 in early 2023 to over $140 by late 2024, nearly doubling. And at the peak, Ellison, who has been with Oracle since founding it in 1977, is selling billions. Ellison is worth over $150 billion. He doesn't need liquidity. He is selling because he knows Oracle at $140 is overvalued relative to the company's real growth trajectory and the true cost of the AI build-out. The Walton family Walmart. In 2024, various members of the Walton family sold over $2.3 billion in Walmart stock. Jim Walton sold $1.5 billion. Alice Walton sold $500 million. Rob Walton sold $300 million. These are the children of Sam Walton. The family has held stock for 62 years through every market cycle, rarely selling significant amounts because Walmart is the family legacy. But in 2024, all three siblings executed large synchronized sales within months of each other, precisely as Walmart stock hit all-time highs above $80 per share. The ultimate dynasty is cashing out. Nvidia insiders. This is perhaps the most extreme example of cynicism. The pattern is undeniable. The most successful operators of our generation, people who built trillion-dollar companies, people who've held stock for decades, are all selling at the exact same time. And the total aggregated amount is staggering. Total insider selling in 2024 reached $464 billion. That's the second highest year on record. The highest? $650 billion in 2007. Let me repeat that. 2007, the year before the worst financial crisis since the Great Depression, the year before the S&P crashed 57%. That is the only time in history when insider selling exceeded 2024 levels. And if the current rate continues, 2025 is on pace to exceed even 2007. Now, let me show you the 5 historical patterns that prove insider selling predicts crashes with absolute, terrifying certainty. Because this isn't coincidence. This is financial science. Pattern 1. The 12 to 24-month peak lag. The data is overwhelming. In 1987, before the October crash, insider selling spiked 350% in the first half of the year. The market peaked in August, crashed in October. Insiders sold 6 to 8 months early. In 2000, before the dot-com crash, insider selling hit records in late 1999 and early 2000. The Nasdaq peaked in March 2000, then fell 78% over 2 years. Insiders sold at the top. In 2007, insider selling reached $650 billion. The market peaked in October 2007. The S&P fell from 1565 to 666. By March 2009, a 57% decline. Insiders sold 6 to 12 months before the peak and 12 to 18 months before the bottom. The pattern is consistent. Insiders see problems developing. They sell while prices are still rising because retail investors and institutions are still buying. Then the crash comes. The insiders who sold at 90% and 100% of peak prices watch from the safety of cash as stocks fall 50% to 60%. Then they buy back at the bottom. This is how wealth is systematically transferred from the public to the insiders. Sell high, wait for the collapse. Buy low. Pattern 2. The 8-to-1 ratio threshold is perfect. The Washington Service has tracked this since 1975. Every time the sell-to-buy ratio exceeds 8-to-1 for an extended period, a crash follows within 24 months. In 1987, the ratio hit 9-to-1 in June. The crash came in October. In 2000, the ratio hit 11-to-1 in Q1. The crash started in March. In 2007, the ratio hit 8-to-1 by mid-year and spiked to 10-to-1 by fall. The crash started in October. The pattern is perfect. 8 times since 1975, the ratio exceeded 8-to-1. 8 times a crash followed. 0 false signals. Right now in 2024, the ratio hit 9-to-1 for the full year. In Q3 2024, it spiked to 12 to 1. This is the most extreme reading since 2007. If the pattern holds, and it has held for 50 years, a crash is coming within 24 months. That means late 2025 or 2026. Pattern 3. Insiders in the most overvalued sectors sell first. This tells you exactly where the pain will hit. In 2000, tech insiders sold while the Nasdaq was soaring. They knew valuations were insane companies with no profits trading at 100x sales. Tech crashed 78%. In 2007, financial sector insiders sold first. CEOs of Lehman, Bear Stearns, Countrywide, they all sold in 2006 and 2007. They knew their companies held toxic assets. They got out. Financials crashed 80% plus. In 2024, what sectors are insiders selling? Tech and financials again. Nvidia, Meta, Amazon, Oracle, all tech, all selling. JPMorgan is financials. This tells you which sectors are most overvalued and most at risk. Tech is in an AI bubble. Valuations assume infinite growth. Insiders know it's unsustainable. Financials are sitting on the commercial real estate time bomb. Insiders know the loans will default. They're selling both sectors. That's your roadmap. Tech and financials will lead the collapse. Pattern 4. The exit of the builders marks the top. Bezos held Amazon for 30 years. Zuckerberg held Meta since its founding in 2004. Dimon held JPMorgan for 18 years. Ellison held Oracle for 47 years. These are not traders. These are builders who held through every single crash. The fact that they're selling now means they fundamentally believe current valuations are as good as it gets. They've lived through 2000, 2008, 2020. They know what crashes look like, and they are choosing to liquidate now. That means they see 2024-2025 as a generational top. When the greatest long-term holders in history become sellers, the market is topping. Pattern 5. Massive insider selling is never followed by new highs. This is the killer statistic. Since 1975, every time insider selling exceeded $400 billion in a year, the market either crashed within 24 months or entered a brutal multi-year bear market. After 1987, new highs took 2 years. After 2000, new highs took 7 long years. 2007. After 2007, new highs took 6 years. 2013. 2024 insider selling, $464 billion. If the pattern holds, the S&P will not make new highs above the 2024-2025 peak for at least 3 to 5 years. We are either at the top now or within months of it. Everything after is decline and agonizing recovery. The insiders are telling you this with every dollar they sell. Now, let me show you what the billionaires are seeing that you're not, because they have access to data and analysis that retail investors never see. First, they see the Buffett indicator screaming overvaluation. This is Warren Buffett's preferred market metric. Total stock market capitalization divided by GDP. When stocks are worth more than the entire economy's output, it's overvalued. The historical average is 80% to 100%. Above 150% is bubble territory. The Buffett indicator currently sits at 185%, the highest in history except for the brief COVID spike. This means stocks are valued at nearly double the economy's output. For this to be sustainable, you need to believe either A, the economy will grow 50% while stocks stay flat, or B, corporate profit margins will double from here. Neither is realistic. The indicator must revert to the mean. Mean reversion from 185% to 100% means stocks fall 46%. The billionaires see this. You see it too now. Second, they see the Shiller PE at bubble levels. The Shiller PE, or CAPE, cyclically adjusted price to earnings, measures stock prices relative to 10 years of inflation-adjusted earnings. Third, they see margin debt at dangerous record levels. Margin debt is money borrowed to buy stocks. Investors are leveraged up, wildly bullish. Margin debt hit $950 billion in late 2024, near all-time records. This is dangerous because leverage amplifies both gains and fatally losses. If stocks fall 30%, leveraged investors get margin calls. Brokers force them to sell to cover loans. This creates a catastrophic cascading forced liquidation. In 2008, margin debt was $850 billion at the peak. As stocks fell, margin calls forced selling. The selling pushed stocks lower, more margin calls, more forced selling. Margin debt collapsed from $850 billion to $280 billion in 18 months. That $570 billion in forced selling accelerated the crash. Right now, we're at similar levels. The billionaires know when the market turns, this $950 billion in leverage will become forced selling that accelerates the decline by 2x or 3x. So they're exiting before the cascade. Fourth, they see commercial real estate actively collapsing. Office buildings sit 40% to 50% vacant due to permanent remote work. Buildings bought in 2019 to 2021 at peak prices with 3% mortgages are now worth 40% less. Those mortgages are maturing now. Owners need to refinance at 7% or 8%. The math is broken. This $2 trillion refinancing crisis will hit regional banks first and then cascade into the heart of the financial sector. Dimon sees the delinquencies in real time. They're selling. Fifth, they see the corporate debt refinancing crisis unfolding. U.S. companies owe $13.5 trillion. Sixth, they see federal debt spiraling out of control. The U.S. government owes $36 trillion. The deficit is $2.4 trillion per year. Interest payments hit $1.2 trillion annually, more than we spend on defense. By 2027, if rates stay at 5%, interest hits $1.8 trillion. This is mathematically unsustainable. The government must either A. cut spending by $2 trillion, politically impossible, B. raise taxes massively, economically destructive, or C. print money causing inflation and dollar devaluation. None of these options are good. All are destructive. The billionaires know the debt spiral ends in a financial crisis, currency collapse, or both. They're converting to hard assets and diversifying out of pure dollar exposure. Seventh, they see their own company's internal data deteriorating. This is the secret sauce. Bezos sees Amazon's real sales growth slowing, not the reported numbers, but the real internal daily metrics. Advertising revenue growth decelerating. Margin compression. AWS cloud growth slowing as enterprises cut costs. Zuckerberg sees Meta's real engagement metrics, time spent declining, ad pricing under pressure, and AI costs exploding without clear ROI. Dimon sees JPMorgan's real loan quality delinquencies rising, charge-offs increasing, and commercial real estate losses mounting. This is proprietary data. You won't see it until quarterly earnings in 3 months. By then, the stock will have already fallen. The insiders are selling now because the internal data says growth is slowing, margins are compressing, and stocks are fundamentally overvalued relative to future earnings. These 7 data points tell the same devastating story. Stocks are overvalued by 40% to 50%. The economy is slowing toward a severe recession. Corporate and commercial real estate defaults are accelerating. Federal debt is unsustainable. And internal company data is deteriorating. The risk-reward for holding stocks is terrible. Potential upside? Maybe 10% to 20% if the bubble continues. Potential downside? 50% to 60% when it crashes. When you're already worth $100 billion like Bezos, risking $10 billion to make $1 billion more doesn't make any sense. It's better to sell, preserve capital, and buy back after the crash at 50% off. Now let me show you the timeline based on these historical patterns. When does the crash come? The average lag between peak insider selling and the market crash is 12 to 18 months. In 1987, heavy selling in Q2, crash in Q4, 6 months. In 2007, heavy selling throughout 2007, crash started October 2007, concurrent to 12 months lag. The pattern consistently shows a 6 to 18 month lag. 2024 saw massive selling throughout the year, especially Q2 and Q3. If the pattern holds, the crash window is Q2 2025 through Q2 2026. That's 6 to 18 months from peak selling. But there are additional timing factors. Presidential election cycles matter. Markets tend to peak in the second or third year of presidential terms. 2025 is year 1 of a new term or second term. The real danger is year 2, 2026. Commercial real estate defaults peak in 2025-2026 as mortgages mature. Now, let me show you who wins and who loses. Who wins? The billionaire insiders who sold in 2024. Bezos sold $13 billion at $170, $180. If Amazon falls 50% to $85, $90, he can buy back twice as many shares. He doubles his stake for the same money. Zuckerberg sold $9 billion at $450, $500. If Meta falls 50% to $225, $250, he buys back at half price. Dimon sold at $155, $165. If JPMorgan falls 40% to $95, $100, he buys back and makes 50% on the round trip. This is the game. Sell high, wait for crash, buy low, increase stake. The billionaires who sold in 2024 will be wealthier after the crash than before because they'll own more shares bought at lower prices. People who hold cash and gold win. Cash is dry powder. When stocks crash 50%, cash buys assets at half price. This is when generational wealth is created, not by panic selling at the bottom, but by buying quality assets at distressed prices. Gold preserves purchasing power. When the crash comes, the Fed will print trillions to bail out the system. That money printing devalues the dollar. Gold maintains value. People who allocated 10% to 20% to gold protect wealth while stock investors lose 50%. Short sellers win. Those betting against overvalued stocks. Michael Burry made $700 million shorting subprime mortgages in 2008. John Paulson made $15 billion. But this is high risk. Timing is everything. Most people shouldn't short, but professionals who time it right make fortunes. Who loses? The middle class loses the most. Middle class wealth sits in three places: 401k retirement accounts, home equity, and savings. All three get crushed. 401 kiloseconds are 70% or 80% in stocks. Retirees and near-retirees lose catastrophically. If you're 65 with $800,000 saved and planning to retire in 2025, and the market crashes 50%, so what do? You can't stop the crash, but you can position to survive it and profit from the recovery. First, reduce equity exposure. If you're 80% stocks, reduce to 40% or 50%. Raise cash. Yes, you might miss gains if stocks rise another 10% or 20%, but you'll preserve capital when they crash 50%. The billionaires are raising cash. You should too. Second, hold 10% to 15% in gold. Physical gold or GLD ETF. When the crash comes and the Fed prints trillions, gold surges. It did in 2008 to 2011. It doubled. It will again. Gold is insurance against monetary chaos. Third, have a buy list ready. When stocks crash 40% or 50%, when everyone is panicking, you need to know exactly what you're buying. Quality companies with strong balance sheets: Apple, Microsoft, Visa, Costco, Johnson & Johnson. Make the list now. When the crash comes, deploy cash systematically into these names at half price. Fourth, don't short unless you're an expert. The billionaires aren't shorting. They're selling and raising cash. Shorting requires perfect timing. The market can stay irrational longer than you can stay solvent. Just sell or raise cash. Wait, fifth, protect your job and income. Build an emergency fund of 12 months of expenses. In a recession with 10% unemployment, you might get laid off. Having cash reserves lets you survive without forced selling of investments at the bottom. Sixth, position psychologically. The crash will be terrifying. Media will run 24/7 crisis coverage. Your friends will panic. Your 401,000 will be down 50%. You'll desperately want to sell at the bottom. Don't, that's when you buy. Prepare mentally now so when the crash comes, you can act rationally while everyone else panics. Let me end with this. The billionaire exodus is real. $50+ billion in sales from the world's most successful investors. $464 billion in total insider selling, the second highest year ever. The sell-to-buy ratio at 9-to-1, the most extreme since 2007. This is not normal. This is not diversification. This is the smart money screaming at you. Get out. They see the Buffett indicator at 185%, Schiller PE at 34, margin debt at records. Commercial real estate collapsing, the corporate debt refinancing crisis, federal debt spiraling, and their own company's data deteriorating, and they're selling. The pattern from 2007 is repeating. Exactly. Heavy insider selling 12 to 18 months before the crash. We're in that window right now. The crash is coming. Q3 2025 through Q2 2026 is the danger zone. Maybe sooner if a catalyst appears. Maybe later if the bubble extends, but it is coming. The billionaires are telling you with their actions. $13 billion from Bezos, $9 billion from Zuckerberg, the first ever sale from Dimon. They're not wrong. They're early, but they're not wrong. If this documentary showed you a pattern you didn't see, if you understand that the largest insider selling event since 2007 is happening right now, then you have a choice. Ignore the signal and hope you're lucky, or recognize the pattern and position accordingly. Reduce equity exposure. Raise cash, hold gold, make your buy list. Prepare psychologically, because over the next 12 to 18 months, everything changes. The billionaire exodus has begun. The pattern is clear. The crash is coming. Position yourself accordingly.